Welcome to the end of the quarter, everybody. We are finally at week 13 of the year for our shift tracker of the local real estate market, going over our 10 key metrics that we have been reviewing, obviously, since the beginning of the year. Now, we have sort of two different updates for you today. One is going to be a little bit of looking at what we've been tracking, but I also want to bring in, and I know this is going to sound a little far-fetched, but a little economic and political, if I can say that, not a bipartisan political, just an acknowledgement of some things that happened on the political sphere that may affect us. I am probably like you, and you're probably like me, or maybe you're not. I do tend to be on a little bit of an information diet when it comes to some of the heavy politics. I think it can be a little, how can I say this, just extreme on every level. So I try to keep a lot of that out, but I do think it's important that we address it a little bit. So let's talk from our stats for today. Now, what we're finding as we have gotten a little bit farther into the year, there's not as many highest and lowest across all the categories, but I think we've now boiled it down to the four categories that are probably the most important for us to track. Total active listings are the lowest they've been. The total available homes, if you were to just start shopping today, how many homes you have available to you is the lowest it's been all year. So that's the lowest. And obviously, the amount of volume, or the total sum of all the list prices of all the homes on the market, that's also at the lowest. So we have the lowest total volume, and we have the total units available on the property, or on the market, right? Properties available. So let's put that off to the side for a second. What's the highest, though? Well, first off, the highest is under contracts. This spring market is heating up. It's fast. Buyers are out. People are looking to shop. People are putting good offers in. Highest and best, 20 plus offers on a property. That's all back again. It's like COVID all over again. Hopefully not with the pandemic part. Okay. The other thing that's highest, prices. We've now jumped another $100 up higher from our previous week, $319,900, up to $320,000 in a median list price. That is the highest that it's been all year. So the amount of properties going under contract, highest. The total average sale price, highest. The total active listings, lowest. The total volume on the market, lowest. This is a week for economics to show off. Reduce my supply, increase my demand, increase price. So that's the first part of what we're just looking at and what we know about. And we know that that reflects into fast markets. I'm telling buyers 3-day rules, meaning you got to see it, know about it, get out and put an offer on it within 3 days, or else the chance that you're going to have to even see it goes down dramatically. So we obviously have those conversations. Conversations with sellers are not really about, or am I going to get the price I want, or am I going to have the traffic I want? We know we're going to get that. The biggest conversation with sellers is, where do I go once I sell? That's the hardest conversation with a seller right now. I literally just reached out to an agent. They were on Maple Shade, on market for 13 days, called for highest and best. Then I saw it was withdrawn. Normally you would see that go under contract. So I reach out to, hey, what's going on? What happened with that property? Seller couldn't find anything. Seller couldn't find anything that they were willing to move into, or able to move into for that matter. And we couldn't even go forward with the sale because we couldn't find something to move into. And this is where interest rates come in. And this is our segue into talking a little bit about interest rates and sort of what the Fed is trying to do. Now, over the past week, the Fed met about a week ago. They did increase rates by another 0.25%, by about 0.25%. Now, we already had that baked into the last time they spoke, and we kind of knew that was coming. But again, the whole point of them trying to bring these interest rates up even more is to curb inflation. They're trying to cut down inflation a little bit. They're trying to take some of the liquidity out of the market and suppress the market a little bit. And they do that by raising interest rates and making capital a little less free flowing, right? Since last February to this February, inflation was 6% year over year, higher than it's been in decades, right? So that's a big issue there. Now, here's one thing that we also saw come up recently. We saw the Silicon Valley Bank situation, which then cascaded into a few other banks around the country. Bank instability, lack of clarity into the banking industry, the strength of the banking industry. Now, the government stepped in and basically said they're going to protect all deposits, even above that $250,000 amount, for all depositors of that bank. And what they've done with some of these other ones, it might be similar. I'm not 100% sure. But there is a little bit of fear in the market right now about this fractional lending policy. Fractional lending is basically just where banks will say like, okay, I'll take in $1,000, but I'm going to lend out almost $10,000 because I basically assume that not everybody's going to need their money at once. It's called fractional banking. It's how banks have made a lot of money, right? It's how our capitalist system grew as much as it did. Problem is when you have a run on a bank where a lot of depositors all want to go get their money all at once, the bank simply doesn't have that cash. So that's a natural thing, but it's good that the government stepped in to protect those so we don't have the run on the banks as much anymore. But here's one other thing, and this is where we're going to kind of wrap up for today, but it's a little food for thought at the end of the quarter. The US dollar has been the US's number one, pretty much our world leader. We might think it's our military, but it's the US dollar. And the reason why it's the US dollar is because the world trades oil in the US dollar. When China and Russia want to trade oil, they have to first convert it from the yuan in China into the US dollar and then back to Russia into the Russian lira. So and I don't even know if that's the right Russian. Somebody will correct me on that, but that's fine. But the point is, they have to do that. Now, what the U.S. can do anytime you trade with its debt obligation instrument or the U.S. dollar is they can impose sanctions on those companies because of the dollar. Well, Xi Jinping and Vladimir Putin met and they signed a bunch of documents moving themselves towards not having to do that, not having to transfer, especially for oil trade and for different energy trade and different things like that, is to remove the US dollar as part of their transitionary economics. Now, here's the problem. Right now, the US dollar has its value based on the Federal Reserve System and the liquidity of cash, and the fact that we would always have that, right? And it's based because every country trades in the US dollar. So we know it's a strong currency and it is tied to very repeatable value all throughout the globe. What happens to the US dollar if the BRIC countries, Brazil, Russia, India, and China, then remove themselves, plus Russia, right? Plus China, plus all this other stuff that we still have going on now, where they're trying to remove the US dollar from that equation? What happens to inflation then? So the question I have for you is if you don't have your money currently in hopefully a cash flowing asset, do you have your money like an investment property? Do you have your money in a property that will at least go up with inflation? Now, it's one thing to park your capital in a home that you live in. That's fine. Because as inflation goes up, the value of the dollar becomes a little bit less, and what you're going to sell for is more, and you do build equity. Now, a lot of people could make the argument, well, if the inflation goes up too much, the equity isn't quite worth as much from a buying power perspective. And you're totally right, but money is also still money at that point. You are going to have more of it if the inflation goes up and you have parked. The biggest problem as we start to get into this inflationary period, if we are going to do that, and if we're going to stay into a recession, is if you have money just sitting in bank accounts, just sitting in a checking account, or even maybe a low interest savings account, you are going to be left behind. If I have $100 in my bank account today and then inflation increases, I don't have $100 worth of buying power anymore. I might have only $95 worth of buying power based on those previous times economic values. So what I'm trying to get to here, if you do have cash and you're sitting on the sidelines, maybe we start to have a conversation about getting you an investment property to have a safe place to park your cash that will rise with inflation, and you can start to have a cash flowing asset that no matter what happens to the New World Order, no matter what AI does to us, people need to live in homes, and who owns that home can charge market rent. And as prices go up, guess what happens to rent prices? Those also go up. So maybe this isn't the best time for you to flip out of your primary home and into another one because of interest rates or because you don't want to find something else or whatever it is, or just the speed of the market's scary for you. But there are opportunities to be had in the investment market right now to be able to, again, take your cash and put it into cash flowing assets that will ride the inflation wave and help to recession proof you. So that's it for today. I hope I didn't get too political with you, but we do need to be aware of some of these things as it relates to us on the home front here, talking about buyers and sellers and homes. So anyway, have a good week this week. Congratulations on making it to the end of the quarter. And let's hope that Q2 is not what we just experienced, but who knows? All right, y'all. Have a great day, and we will talk to you soon.